Good morning, Junior Turkey. Today we are going to look at a new chapter, and that is credit sales and returns. We are specifically going to look at the debtors journal and the debtors allowance journal and the posting of those two journals. So, first of all, we're going to look at a bit of a theory question, and we're going to say, and they're saying, state the three advantages to a business for selling on credit to its customers. So, in other words, why would you now decide to sell on credit? Well, it can obviously increase your sales. Your sales increase will lead to more profit, and it can even help with building customer relationships. So, if you have long-term customers and you are now building that relationship, it's always to your benefit. Then, briefly explain the difference between credit purchase and a credit card. Now, if you buy or allow your customers to buy on a credit, they have an account with your business. In other words, they have a store card like an Eckers card or a Woolies card, and they then buy on credit, and they will owe buy now and pay later, but they owe you as a business money. When it's on a credit card, it is seen as cash to the business because the customer will owe the bank money. So when it's a credit card, it's personal debt of the customer to his or her bank account. Okay, and then what is the advantages of allowing your customers to purchase on account? So, or two disadvantages, sorry, the risk of them not paying, and obviously if they're not paying, you can run into cash flow problems. Then Aaron Brown, the owner of Brown's General Dealer, was approached by a customer, G. Green, who wanted to open an account, and this would mean that he would be able to buy on credit from Brown's General Dealer. Describe step by step the procedures that Aaron Brown should follow before he allows G. Green to buy on credit. Now, this is where the new Credit Act comes in. You can't just give credit to anybody. You have to do certain things or follow certain steps in order to allow people to buy from you on credit. And there's two reasons for that. First of all, to protect you as a business owner, in terms of that you do some checks and making sure that whoever you give credit to will be able to pay you. And then second of all, to protect the customer or the consumer as well, and make sure that they don't get so deep into debt that they can't pay any of their debts. So the first step is to fill out a detailed application, and this must include your monthly income and expenses, a proof of your residence. It's important to know where this person lives to get hold of him, a copy of your ID, 3 months of salary slips and bank statements to show that you're actually permanently employed and that there is money flowing into your bank account, and that you are not in overdraft all the time, that you can manage your funds, your finances okay. Then you run a credit check and verify all the details of the documents. So you make sure that it is this person's ID, and you sort of phone and to make sure that he's at that residence, and phone his work to make sure he's permanently employed, things like that. And then you set a credit limit to what he is able to afford. So in other words, you look at his monthly income and expenses, and you see, okay, after his normal income and expenses, he has about, let's say, a cash flow of 10,000 Rand. So let's set his credit limit to, let's say, 6,000. So if there's any unexpected expenses and he spent all his money, or he spent all his credit limit, he can still afford to pay you back. Then, obviously, after you've approved it, you have to monitor his spending and payments carefully and make sure that he doesn't overspend on his credit limit and that he pays on time. Then I just want to go into a bit of detail with your new terminology, and you can refer to your theory booklet as well. Most of you should know most of these terms. Credit sales shouldn't be new. That's when we sell on credit to a customer. The customer who buys from us now is called a debtor because he's in debt to us. A credit limit is the maximum amount you can buy. and so forth and so on. And then your creditors' allowances, that is a new term though. So an allowance is a journal where all goods that are returned by the debtors are recorded, or sometimes they claim a discount because there was an error on an invoice or the goods were damaged or whatever it might be. And then your source documents is a duplicate invoice or a duplicate credit note when it comes to returns. Then your debtors journal, certain keywords. Now, always have your keywords next to you somewhere when you're doing these journals. It helps a lot. So you look for words like invoice issued, credit sale, sold on credit, or sold on account. And your source document is always a duplicate invoice. Now, sometimes they refer to it as a tax invoice. They refer to it as a tax invoice because VAT of 15% is charged. But it is very straightforward. Quantity is how many things you bought. Description is what you bought. Unit total, how many of that, or what is the price per unit. And then the final price will be your quantity times your price per unit. And then obviously after that, the final total at the bottom of your duplicate invoice is the amount that is recorded in your books. Then the layout of the debtors journal, this should not be new to you at all. The document number is always a duplicate invoice. The debtor's name, the folio is always the debtor's ledger account number, because every debtor has a account with you, so you have to number them. And then the sales will be your total invoice, and your cost of sales is the amount that you have to calculate. Nothing new. You should have covered this in grade 9 as well. Then we have the debtors allowance journal. Now this is a new journal. Now when we have the debtors allowance journal here, your keywords, if some of this is slightly unclear, please refer to your theory booklet as well. But now the debtor sends back goods, and we issue a credit note, or we received a debit note from a customer, or the return of damaged goods, or the incorrect marking or an allowance was given to a debtor. The source document is your duplicate credit note. Yet again, very similar to an invoice, but now it's just called a credit note. What you sent back, how many, and the amount for it. And then your creditors allowance journal looks basically copy paste like your debtors journal, and the one difference is the sales column is now replaced with the debtors allowance column. So the allowance amount is now the part of discount for the sales price, and then you have to work back to the cost of sales because you have to record the return of the stock as well. But we will go into more detail when we do an actual activity. So the next activity will be on the revision of a debtors journal and the recording of the returns and sales allowances. I hope that you look forward to this section. It's quite interesting, and this is where accounting actually happens. And good luck for everybody. Thank you.